Traditional or Roth IRA. Depending on your position, one may be better for you than the other. And by watching this video until the end, you are going to become a true black belt expert over this topic, as you're going to learn the similarities and differences between these IRAs, which is going to help inform you on which option is going to be better for you. With that being said, let's get straight into it and talk about the similarities between these two IRAs. Now, both of these accounts are IRAs, which stands for an individual retirement account. This means that these accounts provide you with tax advantages, which I will discuss the differences later on in this video. But in order to fund either of these accounts, you are going to need an earned income as well. By earned income, I mean wages, tips, salaries, or any other taxable income that you are going to earn either from your own work or from working for somebody else. Another similarity with these accounts is the amount that you can contribute into them, and this is called the contribution limit. As of 2023, that is $6,500 if you are below 50 years of age, and if you are above 50, it gets bumped up to $7,500. This amount increases over time, so by the time it's 2030, it could be $8,000, $9,000, $10,000. Who knows? But the contribution limits are combined across the traditional and Roth accounts. So if you want to invest into both of these accounts, you would have to split as you wish. For example, let's say that you were under 50 as of the year 2023, which means the max contribution is $6,500. You could split this up by putting $3,000 into a traditional IRA and then the remaining $3,500 into your Roth. Or what's more common is just contributing the full amount into whatever account is best for you. Another important fact is that you are able to contribute to your account up until that tax year's deadline, which is typically April 15th. Unless it falls on a weekend or a holiday, it would be the next closest business day. This is extremely convenient for some because let's say that it's March and you have $4,000 in your IRA from the previous year that you contributed. You still have until the tax deadline to continue contributing if you would like. Now, another similarity between these IRAs is that they do not interfere with any employer-sponsored retirement accounts like 401k or 403b, so you can continue to use them. All right, so that covers the similarities between these IRAs. Let's now make it more interesting and talk about the differences. For starters, when you contribute money into a traditional IRA, the type of money that you are contributing is called pre-tax money. This means that you are contributing money that does not require you to pay taxes on the earned income up front. The tax incentive is that you are able to deduct from your taxes the amount that you contribute into this traditional IRA. So if you fund the account with $6,500, you should be able to deduct this from your taxes. I say should because be aware that this can be somewhat complicated because the IRS states that if you have a retirement plan, or even if you don't but you're married and your spouse does, then you are limited to how much you can deduct, and depending on the circumstance, that can mean no deductions at all. I will leave a link to this and one more from Fidelity in the description of this video in case you are interested and want to learn more for your personal situation. Now, on the other side of things, when you contribute money into a Roth IRA, this type of money you are contributing is called after-tax money. This means that you are contributing money that you have to pay taxes on in the current tax year. So an overall view is that a traditional IRA you can potentially deduct from your taxes, where a Roth IRA you have to pay taxes up front. Another similarity is that their earnings grow tax-free. This means that any dividends, capital gains, or interest that is earned does not get charged taxes on throughout the years. So whatever trades you make throughout the years, the government will not charge you for it. This is extremely important because it moves me on to talking about the withdrawal rules from both of these accounts, which for a traditional IRA, eventually everything is going to be taxed from the account. Now, if you withdraw before you are 59 and a half, then you will be taxed on your contributions and earnings as ordinary income, plus an additional 10% penalty fee. Now, I don't know about you, but that doesn't sound too good. But what's unique about a Roth IRA is that because you've already paid taxes on the contributions, the amount of money you put into this, if you want to withdraw your contributions, you can do this at any time, tax-free and penalty-free. For example, let's say that you contributed $40,000 into your Roth IRA and the account has grown to be $70,000. If all of a sudden an emergency comes up and you need $20,000 right away, the worst case scenario is you can pull that from your Roth IRA with no taxes or penalties at all. But if you ever need to withdraw more than what you've contributed, you are going to have to pay taxes on the earnings. And then you would also have to pay an additional 10% penalty fee unless you qualify for one of the situations like these that can allow you to avoid the fee and, for certain circumstances, even the taxes. But where it gets interesting is that once you reach the key age of 59 and a half, you can withdraw from either of these accounts without any additional penalties. And when you begin to withdraw from a traditional IRA, you are going to be charged an ordinary income rate, where when you withdraw from a Roth IRA, you have to pay 0 taxes. Literally nothing, because they are tax-free and penalty-free. The government's not going to come and ask you to pay taxes. Taking that, when you have this Roth IRA, you have to hold onto the account for at least 5 years before you're able to withdraw after the age that is the key age, 59 and a half. Now, if you're interested, I've recently made a Roth IRA how to become a tax-free millionaire video that I highly recommend you checking out if you're interested. I'll leave a pop-up here and a link in the description below as well. Something else you should know about traditional IRAs that Roth IRAs don't have are called required minimum distributions, RMDs. Beginning in 2023, this means starting at the age of 73, you are actually forced to start withdrawing from your traditional IRA. And in fact, beginning in 2033, the age is getting bumped up to 75. And there are also heavy fees if you fail to take the required minimum distribution, or even if you don't take the full amount. I will leave a link below for you if you want to see the details for that. Now, you're probably curious, how much do you have to pay? And this amount is calculated by dividing the total value of your traditional IRA by a life expectancy factor that is determined by the IRS. The IRS does this to ensure that any accounts with pre-tax money will eventually pay their taxes. And because the contributions that you put into your Roth IRA are already taxed, you're never forced to withdraw from your account. Now, another way that traditional and Roth IRAs differ is from their income limits. For a Roth IRA, this means that if you have over a certain income, whether you are single or married, you will be limited or even restricted from being able to contribute to your Roth IRA. For example, if you are single and have under a $138,000 modified adjusted gross income, then you can contribute the max limit. For this case, it would be $6,500. But if you had in the range of $138,000 to $153,000, it would be reduced and then completely restricted if you surpass $153,000. And if you are married, these numbers will be higher, but with the same concept. And on the other hand, for a traditional IRA, there are no income limits, which means that you can have any income and still be able to contribute. For some reason, the government allows what is called a backdoor Roth IRA. Basically, what you would be doing here is contributing to a traditional IRA because there's no income limits. So if you have a higher income and you cannot contribute to a Roth IRA, contribute to a traditional IRA, and then you can convert that. You pay the taxes, all of it, the full amount. You can then convert that to a Roth IRA. So a little fact for you is that a traditional IRA is considered to be a tax-deferred account, and this means that eventually you are going to have to pay taxes. And a Roth IRA is considered to be tax-free because when you go to withdraw, you do not have to pay any taxes at all ever again after you initially contribute. So with all that being said, let's now go over which IRA would be better to use. Because you've stayed this far into the video, I'm going to be completely honest with you and tell you that there are a lot of people out there that take this into much more thought than there needs to be. The biggest factor to consider is truly your own position. I say this because if you were in a lower tax bracket right now and expect to be in a higher one in the future, then it would make sense to go with a Roth IRA. Where for a traditional IRA, if you have a high income right now and can benefit from actually deducting it from your taxes, this could make sense, especially if you are going to have a low income when you begin to withdraw after that key age 59 and a half. But to be honest, I don't necessarily think that a traditional IRA is worth it, at least to most of you that are watching this video. Now, if you don't trust what I say, let me show you with a real example. Let's say that you are currently 30 years of age and do not have a Roth IRA, so you are planning to start one right now. Because you've missed out on a few years, you want to max out on your contributions, so that would be $6,500 every year from here on out to make sure that you can get a good retirement. So if you invest into a strong US index fund and let's say it gets you an 8% return on your investment, then that means, let's say by the time that you are 65, that you will have contributed a total amount of roughly $230,000, which is not including the fact that once you hit 50, you could actually contribute even more. But through this calculation, your Roth IRA would have grown to roughly $1.3 million. Now, if you do this in a traditional IRA, you don't have to withdraw this all at once. You could space it out over the years, but eventually you're going to have to pay taxes on that entire amount. No matter how well you manage that and how low of an income you have when you do withdraw, you are still going to have to pay at least a few $100,000 in taxes from that amount. Where for a Roth IRA, you would have already paid taxes on the $230,000 that you contributed, but from here on out, the rest of the growth is completely tax-free. So for this case, that means that roughly $1.1 million is tax-free. You don't have to pay any taxes on that. Now, I'm not going to go into extreme details because that would make this video a lot longer, but the difference between these two accounts for this example would have to be a couple $100,000. Now, if you really want to see what exact age it would be better to do a traditional over a Roth IRA, I think you're going to be surprised to find out that it's going to be sometime in your 50s And that's including the fact that your portfolio doesn't grow well, which you want it to grow well, and you are actually able to deduct from your taxes. Besides that, the Roth overpowers the traditional tremendously. So if you are serious about growing your own wealth and you have some years for this to compound, it would make much more sense to get a Roth IRA that you can avoid taxes on the growth, where a traditional IRA, if you actually grow, which you want your account to grow, you would have to pay taxes on all of the growth. So if you expect your account to grow substantially, why not get the account that allows you to avoid taxes on the growth? I'm not saying a traditional IRA is bad, because for some cases it could be extremely beneficial if you are able to deduct from taxes and use that money or invest it in a strategic way. I just personally think that overall, the Roth trumps the traditional. With that being said, I truly believe that if you are under the age of 50, that it is clear what approach to take. If you gained any value out of this video, I would really appreciate you hitting that like, subscribe, and notifications button for future Money Talk content that I will be creating. Thank you.